Well, good morning, everyone, and welcome to Burns & Porter Corporate Advisory's webinar on tips for a successful business sale, what to expect before, during, and after. Thank you for joining us. For those of you who may be unfamiliar, Burns & Porter Corporate Advisory is a subsidiary of Burns & Porter, a premier certified public accounting and planning firm in Bellevue that provides comprehensive services throughout the business lifecycle. Our corporate advisory team offers consulting and intermediary services for firms making pivotal business decisions, including the purchase or sale of a company. We offer investment banking, corporate finance, and strategic advisory services. Today's presentation will be facilitated by Jen Lilly, an Assurance Services Principal at Burns & Porter, who also heads our Transaction Services practice, as well as the Managing Directors of our Corporate Advisory subsidiary, Pitt Means and Greg Noon. Before we begin the presentation, I would like to mention that you will be able to submit questions anonymously at any time during the presentation using the question box in the webinar panel on your screen. We will address and respond to questions at the end of each of the three sections of today's presentation. Remember, there are no bad questions, so we encourage you to participate. This is new territory for many business owners, and your question may help a fellow attendee. If we do not get to your question, or if you have additional questions on the content covered today, please contact us. You can find our contact information at the end of today's presentation or refer to your webinar invite. With that, I'd like to hand things over to the first of today's presenting speakers, Pitt Means of Burns & Porter Corporate Advisory. Pitt?
Thanks, Amy, and thanks to all of our participants who carved out some time to join us today. We're going to do our best to make this informative and engaging and hopefully address whatever questions you might have about this process. As a first step, we were hoping to have the audience answer a few quick poll questions just so we can get a sense of who's on the line and maybe cater the presentation a little bit to our audience. So we'll have three quick questions for you to respond to. The first should be popping up momentarily. Looks like it's there. If you wouldn't mind answering that. Great, it looks like most of our responses are in. So thanks everyone, and you know, this is content, I think, for the most part that applies across various industries. A lot of it's sort of consistent, but good to know who's on board. Looks like we have a strong construction presence, and that's services and manufacturing. Great, thank you for that. Here's our next question, just asking sort of what's your best describes your current role within the business. Great. Looks like our responses are in. Mostly owners, CEOs, and the presentation for the most part I think is kind of catered to an owner or CEO, but we certainly feel like there are opportunities throughout the organization to prepare a business for a sale. So certainly, hopefully we have some good content and nuggets for folks in other roles that can help their businesses prepare for a successful sale. And then just our last question here should pop up any minute around the time frame you might be considering for sale. Great. Looks like our answers are in. Yeah, a lot of, not surprisingly, you know, a large percentage there, uncertain. I think this is something that, you know, always good to have on your radar, always good to be kind of thinking about as something that may occur in the future, and good to be ready and sort of run your business as if it's ready to transact, just because you never know. You never know if somebody might approach you or whatever circumstances might arise that make a sale of your business, make it sort of the right time for sale of your business. Well, thanks for that. Appreciate it. Let's jump in. I want to start by discussing some of the preparations business owners address ahead of a potential transaction. And to do so for a moment here, I'm just going to ask you to do a little bit of a mental exercise. I want you to put your buyer's hat on for a moment. Imagine that you're thinking about buying a business, evaluating a business to potentially acquire. So imagine this, or if you've been through this, think back to that time. You're going to part with a substantial amount of capital here and maybe take on some debt. I'm sure there's a lot of sort of questions or concerns that go through your head as you think about an acquisition. I think as a buyer, it's very natural that your focus immediately goes to the risks of the business. I think that's just natural. How do you protect yourself from these downside risks? What do you do that ensures that what you think you're buying, the people, the customers, the revenue, the earning streams, how do you ensure that all that's going to be there tomorrow? That's, I think, where a lot of the initial focus would be. You certainly want to understand or limit your downside risk. And if you eventually got comfortable with the downside risk, I think, at some point you start to think about maybe what are some of those upside opportunities. Where can I take this business? How can I grow it or make it more profitable? And maybe more in particular, are the building blocks in place so that I can grow this business, make it more successful? So, so as a prospective buyer looks at a business, most of their analysis or evaluation is really going to fall into these two buckets. So I'll spend a little time talking about each, limiting downside and maximizing the potential upside, and really how to tee up your business for a buyer. So what are some things you can do in advance of entering into a sale process that are going to address these concerns about downside? There are a few in particular to pay attention to. The first on our list, customer diversification. It probably comes as no surprise that this is at the top of our list. We see this all the time. A company has some early success selling into Microsoft or one of the other local giants in our market, Starbucks, Amazon, Boeing. And, maybe you've become a preferred vendor and the work picks up, the margins are really good. And it's just kind of natural that you might start to focus more and more on this one account. And, 5 years go by, you look up and all of a sudden you're maybe 50 or 75% of your business is with this one customer. And, to some degree, they're consuming your team and maybe you've been, I would say, ignoring other customers, but maybe not committing the resources to other customers that you should, or you've just kind of lessened your selling efforts overall. And like I said, we see this a lot. And while it's a risk that you as an owner probably, get used to, kind of resigned yourself to some degree, you sleep with it every night, it's going to make buyers very, very nervous. They have learned the hard way that these relationships can change. Key contacts leave, or maybe your customer gets acquired, or the customer shifts its strategy or its budgets, or the next iteration of its product, gets, the launch gets delayed or canceled. You name it, buyers have been bitten by something like this, and they have not forgotten. So, I'd say to the extent that you can diversify your business away from a single large customer, it will alleviate this concern for a buyer. And one way to make that shift, I think, is to just put an individual or put a team specifically in charge of sales or production for all of your other accounts, and put goals and bonus programs in place to incentivize this. If you don't, it's really easy to lapse back into the path of least resistance of serving your major customer. Management depth is another concern. A few questions to ask yourself as an owner. Can I take a 2-week vacation and be fully out of pocket? How about 2 months? When your largest customer has an issue, do they call you, or is there someone else within the organization they talk to? Is there someone on your team that's capable and willing to take initiative and lead the organization in your absence? Those are questions a buyer is going to ask because they really want to know how dependent the business is on the owner, even if the owner plans to remain on board after the deal. They need to know that there's a team behind you. So my advice is to, take some vacations, force your team to take on more of a leadership role. If you don't have people that can do that, I think you need to start thinking about finding them, recruiting them, cultivating them. Make sure, and in addition, make sure your customers, your top customers especially, are working with your broader team and not just you. The next item, redundancy, has some overlap with concentration and management depth, but spills into your teams, your systems, your equipment. Are you at risk if a certain employee left or a certain supplier failed or a piece of equipment failed? Does that put your business at material risk? And you're going to want to make sure that you're building redundancy into your operations to protect against single-threaded points of failure. In terms of financial hygiene, buyers don't want to be sorting through financials that are full of adjustments, have internal discrepancies, have unexplained year-to-year variations, or really don't want to see any real surprises that can't be explained for that matter. So, this is a really important topic. We're gonna focus on it a little more. I'm gonna have my colleague Jen Lilly talk some more about her practice, transaction services, and what they do to get ahead of these sorts of concerns. And the last point here is around data collection and tracking. Buyers like data. They like seeing the trends and seeing how key metrics have shifted over time. To the extent you can begin now to define and formally track some things like your backlog and customer segmentation and margins by customer or maybe margins by product line, the more you'll understand about your business, so it could be helpful to you in the short term, but it also it just makes it easier for a buyer to get comfortable with the business and understand how the business has evolved and changed and have some insight into the drivers of that change. So we talked about addressing some of the more common downside risks. Buyers will also want to understand how prepared your business is for growth. They'll often look at a business with the mindset of, how can we double this business in 5 years? So when you get to the stage of talking to potential buyers about your business, you'll want to have some opportunities identified or teed up for the buyer. Every case is going to be different, but certainly having an operation that's already running at maximum capacity, to a buyer is going to mean that the business is really capped until further investments are made. To grow it, the buyer is going to need to, potentially add a shift or add equipment, add additional space. That's, obviously not ideal from their perspective. The business is going to be more attractive to a buyer, and a buyer is going to pay more for it if there's infrastructure in place to at least support some future growth. If you don't want to make those investments, the next best option is to at least put some of the wheels in motion. Investigate the cost and availability of additional space or the cost of the new equipment. Put together a game plan or roadmap so that the buyer who's exploring this path for growth isn't starting from scratch. Similarly, it's helpful to have identified some potential growth opportunities for the business and ideally begin to plant some seeds. If possible, start to test or make small inroads into adjacencies or new end markets beyond the core industries you serve today. I think having a little early data on which opportunities show promise is better than just having some hypothetical ideas on how to grow the business. And lastly, buyers of companies, not surprisingly, like to grow through acquisition. So have an idea of companies that a buyer may want to acquire to add on to your business. Having some potential targets in mind certainly get buyers excited, and even better if you've had if you have a little insight into those opportunities. Maybe you have a working history with them or a past relationship, or maybe even you kind of know the situation, know the owners of the other businesses. I think having a potential pipeline of acquisition targets for them to think about going forward is always attractive. I mentioned financial hygiene earlier. I'm going to hand it over to Jen now to talk about her practice and specifically quality of earnings reports.
Okay, great. Thanks, Pitt. One of the core functions of our transaction services practice is to provide quality of earnings, or a QOE report, for buyers who want to better understand the financial inner workings of a company they are looking to acquire. Other times, a potential seller gets a QOE report completed in advance of marketing their business for sale. This has been done to identify areas of potential concern so they can be addressed before going to market, or to provide a buyer with some added comfort that the selling company's financials have been analyzed and scrubbed by an independent CPA firm. In either of these cases, though, it can lend some assurance on the buy side about the target company's financial statements as well as from the seller's perspective, particularly if the selling company's financial statements haven't been historically audited. But it's also important to note here that a Q of E is not an audit and won't replace the value of having historical audited financial statements done by a CPA. As many of you know, an audit's primary focus is on the historical balance sheet of a company as of the end of its fiscal year, while a Q of E focuses on the economic earnings power of the target company, with the measurement date really focusing on the trailing 12 months. An audit tests and verifies the financial numbers being reported, while a Q of E relies on the target company's internal reporting with further inquiries of management. So in a nutshell, a Q of E report's goal is to really determine the overall earnings quality of a company. In order for earnings to be considered of high quality, the company must reflect positive cash flow, and it must be sustainable. Having a Q of E report prepared and the related due diligence should be able to identify the red flags impacting sustainable positive cash flow. So what goes into a Q of E will really be specific to the given situation, but there are a few common areas to determine earnings quality that we usually look at, which I'll give a very high overview on. The first thing we usually start with is a company's EBITDA for a trailing 12-month period, which I'm sure some of you know, is a company's earnings with add-backs for interest, taxes, depreciation, and amortization. This is where we work with a company's management team to discuss their accounting policies and determine if anything different from generally accepted accounting policies or GAAP. If there are differences, we identify the potential adjustments to normalize the numbers. As a part of this, we look at monthly accruals and reserves to make sure that they are consistently reported. In addition to the balance sheet, we'll also look at revenue recognition to ensure compliance with the company's accounting policy as well as GAAP and perform a trailing 12-month proof of cash. Any differences identified here become potential due diligence adjustments that go into a Q of E report. Once we have a handle on how a company's financial statements are represented, we'll look at a seller or management's adjustments to EBITDA. These typically are obvious non-recurring expenses and perhaps excess compensation that are add-backs and increases to EBITDA. The study for us on the buy side is to verify these claims. Estimates really aren't and should not be accepted, and the rationale for each adjustment should be challenged, and from these challenges come potential additional due diligence adjustments. So going into it, due diligence adjustments are those items identified by the team preparing the Q of E, which can be add-backs or additional deductions to management's EBITDA and therefore impacting the ultimate selling price of a company. These adjustments might include overlooked expenses, accounting errors, and the effects of identified unrecorded or under-recorded liabilities, or even a reversal of the seller's adjustments that failed to hold up to scrutiny, as mentioned previously. A key item to point out here is that the number of these adjustments could give the buyer not only a better understanding of the economic earnings power of the company, but also provide some insight into the quality of the company's information and the strength of the finance team. I should also mention here, too, that another due diligence adjustment to not be overlooked is pro forma adjustments. These types of adjustments take into consideration future increases in rent, labor, or other increases that are known in order to normalize the trailing 12-month earnings. Another important item we typically look at is net working capital for that same trailing 12-month period. This goes back to the comment on looking at the balance sheet accruals and their impact on future earnings. It's very common for working capital to be used as a metric for the purchase price adjustment subsequent to closing. This can work for or against the buyer, so it's very important to understand what working capital has been to understand what a realistic post-closing target working capital number could be. When doing a Q of E report, we also commonly look at potential additional liabilities that are not accrued or disclosed in the financials, as well as identify other potential risk areas. Off-balance sheet items such as this would include lease commitments and deferred comp plans, or does the company have potential tax liabilities related to sales in other countries or jurisdictions? Some examples of risks that could be potentially identified during due diligence are concentrations in revenue, supplier, industry, or product mix, commitments to cost structures and or pricing strategies, or key man issues. This would be where a key salesperson is going to leave once the company sells, or there's a dependence on the intellectual property of the outgoing owner. Sellers can often downplay these items, but something like this, surfacing late in a transaction, could make a buyer skittish or wonder what else is out there. Again, this was just a high-level overview of Q of E reports, the related due diligence, and what's typically included. It certainly can vary depending on the specific deal.
Okay, great. Thanks, everybody. Let's take a minute to pause and get a couple of questions that have come in regarding what we've covered so far.
Yeah, thanks. It looks like we have a couple questions about QV reports that I'm going to ask Jen to address. The first is just sort of what's the time commitment and the cost potentially for a quality of your earnings report?
So the time commitment can vary, of course. It just depends on the scope of work. I would say typically 3 to 4 weeks is a turnaround time for us to come in, get an understanding of the deal and doing the related work. Oftentimes, we kind of call it scope creep. We can look at additional things as more items are exposed. So it could take a little longer, but probably about 4 weeks is a good time frame to look at to actually get the work performed. And from a cost standpoint, for a normal middle market company, probably it's about $20,000 to $30,000 for an actual QOV report. It can be a little bit less if we're just focusing on a few things, and it also can be a little bit more, but that's about your average.
Thanks, Jen. And then one more about kind of if someone's, I think what they're getting at is if someone's thinking about doing a quality of earnings report ahead of a potential transaction, kind of how far in advance of when they think they're going to transact or go to market would it make sense to look into doing one?
Sure. On the sell side, it really makes sense to do it in advance and possibly fix any red flags identified in order to fix them before you go to market. So I would say the very minimum 6 months ahead of time before going to market, but 12 months would be a lot better just to give you adequate time to fix any issues identified.
Great. Thanks for those questions, everyone. At this point, I'm going to hand things over to Gregory Noon to talk about what to expect during a transaction. Gregory?
Thanks, Amy. There are really 4 main stages of a transaction. The first is the preparation of the marketing materials to best position the business for potential buyers. Then comes the initial outreach and marketing of the business to those potential buyers. After that comes the soliciting and negotiating of bids for the business. And then, once terms have been agreed to, the completion of the due diligence and the execution of legal documentation. We have a saying in our business that time kills all deals. Each of these steps are critical, but you want to move as expeditiously as possible through the process. Generally speaking, nothing can happen that would double the value of your business, but there are events that could happen during the process which could cut the value in half or kill a deal altogether. And we'll talk about that more a little bit later. One of the key drivers to success in this process is the creation of competition. To get the best possible deal and to have leverage in negotiations with any buyer, you need to create competition amongst buyers and do so in a way that allows you to compare offers side by side on an apples-to-apples basis. So let's talk about how to create competition through this process. You're going to want to prepare a fairly complete set of materials for marketing your business, and then use those materials with all groups. You want all groups evaluating the company based on the same set of information. Next, we would recommend developing a thorough list of potential buyers and market to all of those groups simultaneously. If you go down the path of getting an offer from one group without knowing where others stand, how do you know if you're getting the best deal? And what leverage do you have to ask for more? Once marketing has begun, you should set a firm but reasonable deadline for interested groups to respond and bid. This creates deadlines and urgency for buyers to make a decision. Otherwise, their decision-making may drag things out indefinitely. Lastly, when you get into due diligence, you need to respond to requests promptly and know when, in certain cases, to push back. This keeps the process moving and also helps you to demonstrate a deep understanding of the data and management levers behind your business. Trying to run your business and sell your business at the same time is a delicate balancing act, and it's not easy. Once you commit to selling, you want to push that process along as quickly as possible. However, for the sale to be successful, you need for the business to continue to perform, so you can't take your eyes off the day-to-day tasks. So I would say be thoughtful about when you decide to launch this process and limit potential distractions along the way. If your business has a busy season, work around that. If key management changes are necessary, then start making those in advance. If there are major business events that are likely to consume your time, like a renewal for your largest customer or a long-awaited new product launch, get those out of the way first. And if possible, be sure that your calendar is clear of any large personal commitments, like international travel or a family wedding. I wanted to come back to the idea that time kills all deals and the notion that you want to move as expeditiously as possible through this process. And I shared this slide and the story in it as a cautionary tale, because you just don't know what might be lurking around the corner out of your control that could potentially kill your deal or maybe even delay a sale for years. And this is a true story. In 2016, I got a text from a colleague with a link to an article from a small newspaper in Western Idaho. I clicked on the link and started to read the article about the arrest of a suspect in an arson case. Someone had hired two guys to burn down a trailer owned by his ex-wife's boyfriend, literally. It sounded like a Jerry Springer episode. And as I read the article, I couldn't for the life of me figure out why my colleague had sent it, until I got to the part that named the guy in custody. He was the general manager of the business that we were in the process of selling. In fact, he was arrested when the buyers were on site doing their due diligence. So, a couple of morals to this story. One, please make sure that your HR manual is clear that employees are not to commit arson. And two, while there's a certain process to selling a business that must be followed, please don't waste time along the way. When you get deep into this process and have a deal in place, race to the finish line. Nothing will be gained by delays. So, this process may seem like a lot to juggle because running your business is a handful and selling your business while also running it requires an equal amount of attention and care. And as we mentioned, you want to move as quickly through that process as you can. And keep in mind that the process is often something that you don't want to share with other employees, so you may not have a lot of help internally. So don't be afraid to get them. One of the things that our practice does is help manage this process for our business owners so they can focus on running their business. Accountants and sometimes outsourced CFOs can be used to gather materials in advance of a transaction or respond to due diligence requests, in addition to the quality of earnings work that Jen spoke about previously. And of course, it goes without saying that you will want to get legal advice from an experienced transaction attorney. This is probably not the time to work with a generalist or your family attorney. Please hire someone who focuses on business sales for companies like yours.
Okay, great. We are going to pause and take our second break and look at a few more questions that have come in.
Yeah, it looks like the first one that came in is around communicating with employees around the potential for a sale. And, generally my experience with this is, there's a pretty tight circle that would be involved in the early stages of a transaction, and that's going to involve, the owner, CEO, maybe general manager, maybe chief financial officer. And generally our recommendation is to keep it to that group until sort of later stages in the process, until the buyer has been identified, there is a deal in place, and a deal seems imminent. At that point, you can communicate the story to employees of, sort of craft the messaging a little bit about why the transaction is taking place, and often the benefits that come with it, and the growth opportunities and the synergies and the exciting stuff that lies ahead. I think when you get into conversations with employees before that, you don't know quite what the process, you don't know who your partner's going to be, or kind of quite how the deal is going to come together, or if it's going to come together. So you create some uncertainty and some anxiety unnecessarily. So generally, we would say kind of hold off on any sort of broader communication until the deal's either done or pretty close. We also had a question come in about the difference between a stock sale and an asset sale. So one is, a stock sale is literally all the stock of the company is sold to the buyer, and the seller is left with essentially just the proceeds, the consideration in exchange for those shares. Whereas an asset sale, sort of in the mechanics of it, is that the business owner retains the entity, but is selling all of the assets, and along with it, many of the liabilities of the business to the new buyer. The difference is, for practical purposes, there are tax benefits often to the buyer for doing an asset sale. There also, in an asset sale, a buyer is identifying and buying or assuming certain liabilities, but a known an identified list of liabilities. So to the, buyers sometimes prefer an asset deal because there isn't the risk that there are other unknown liabilities that could kind of rear up later. Often there's less diligence required on an asset deal as well for that reason. A question here too about sort of working capital and how that's handled in a business sale. Generally speaking, businesses transact, with a, the business is essentially handed over with a normal level of working capital, and normal is obviously sort of a generic term, but often this is, based on a 12-month average and maybe factoring in some seasonality. But there's obviously a certain degree of working capital that comes over with the business. Usually in advance of the sale, in advance of closing, a target is set for what that sort of expected or normal level of working capital is going to be, and if because of the transactions and collections and sales that happen just ahead of the transaction, that working capital number could go up or down, and then there's usually just an adjustment to the purchase price to if for instance you were to deliver more working capital than was promised or agreed to, then you're compensated for that.
And typically what we're talking about there is non-cash working capital. So you would have current assets excluding cash minus current liabilities is what's regarded as working capital.
Yeah, thanks for that clarification. Yeah, generally the cash is the transaction is generally expected to take place on a cash-free, debt-free basis, meaning the seller is responsible for the debt, but gets to keep the cash in the business. And then we also had a question about the impact of a buyer on an SBA sale. SBA loans and sales that use them are pretty common in businesses sort of in that, $6 million range and below. Really the main consideration or main difference is that often there's a expectation or a need for the seller to enter into a seller note where they're essentially loaning money to the buyer to make the acquisition, and that loan sits behind any bank financing. So they're in a secondary position, and there's some risk obviously that comes along with that. And those payment terms when the seller note can get paid, and those are some elements of that are dictated by the rules surrounding SBA. So just that's what we've seen in terms of sort of the one impact on buyers of selling to somebody who's doing an SBA loan. Okay.
Okay, great. Thank you for the questions, everyone. At this point, we are going to move forward, and Pitt will wrap up our conversation with some things to think about post-transaction. Pitt?
Thanks, Amy. So in our work, we have the benefit of seeing a lot of clients through this process, and I like to keep in touch with those clients long after the deals because, we really want to understand what makes for a good marriage in the long run. I mean, it's a deal gets done and there's a history and a path going forward after that, and we want to understand what are the circumstances and scenarios where that really plays out nicely. And I get this question all the time. What's the most important factor in a successful M&A transaction? Because I'm sure we've all heard of some that didn't go so well. And I would say based on my experience as an advisor and also from going through mergers while in operating roles. The front of the list, I need to put the alignment between the two companies in terms of their mission and values. I've personally lived through all kinds of deals. I worked at one company earlier in my career that got acquired. The CEO of the acquired company left within a couple of months, started a competing company across the street. He took a bunch of employees with him. It was really distracting and disruptive, as you can imagine, and obviously not at all what the buyer had intended. I've also worked in situations where the teams had some stylistic or philosophical differences, but came together and did really great things. And I think in those successful deals, the key differentiating factor was that there was a strong overlap in the company's values between the acquiring company and the acquired company. When the teams came together, there's always, when teams come together in general, there's always going to be some differences of opinion as to the best strategy or the best operating model. But if there's agreement as to the end goal and generally speaking, kind of how people want to treat each other and treat people, just sort of the culture and mindsets of the business, that, what I've seen is that the teams generally come together and overcome those differences and join forces in a really powerful way. So I'd emphasize alignment and culture over almost anything else. The integration is also, more likely to go smoothly if there is a shared understanding as to the sort of the go-forward growth strategy. What are we going to do together, and how are we going to do it? And that really starts with leadership. Who's going to lead the organization and make the day-to-day responsibilities, or how are those decisions going to be made, or how is that responsibility going to be shared? If there's an aggressive growth strategy, and often there is, and many initiatives to choose from, what initiatives take priority? What are we going to focus on first? How are those initiatives sequenced? How are they staffed? What people are we going to add? People are we going to draw people to tackle these new initiatives? And also, how are they funded? If a buyer and a seller can have an understanding and some clarity on these fronts ahead of a deal, generally the post-deal integration is going to go exponentially smoother. The last area we wanted to touch on was around financial goals and how those are measured and tracked. This really comes into play most when the seller of a business has performance bonuses or a contingent consideration, like an earnout, where they have a financial, impact, or there's a bonus based on the performance of the business under new ownership. And here's how this plays out. As you can imagine, sometimes a parent company makes an acquisition, and they may decide they need to burden the company they've acquired with some additional expenses, and maybe they require an annual audit or more compliance or just other overhead. And from the seller's perspective, the business was doing just fine without these added expenses. So when being measured for a bonus or an earnout, should these costs count against the acquired company's numbers? And similarly, it can happen in the other direction where, the acquired company is reaping the benefits of the acquisition. They're getting sales opportunities or introductions to prospects, or they're able to reduce costs by getting better rates on insurance plans and stuff like that. In this scenario, does the acquired company get to take all the credit for this additional income? Or how is it shared with the parent? I'm asking, I don't necessarily have answers to these questions. I think the point I'm trying to make is that, it's best to have this discussion up front, best to understand, how this is going to be allocated and measured and tracked going forward, so that when it comes to the paying those bonuses or paying on an earnout, there's, you aren't at a later point in time sort of disagreeing about the methods and procedures for arriving at that. Similarly, it makes sense to discuss how the acquiring company plans to support the growth of the acquired company. If there's a growth plan, and there usually is, right? That's going to require equipment or other CapEx. Is there a budget in place, an agreed upon budget in place that's going to support the growth initiatives and the forecast that's being projected? And when is that money going to release? When is that equipment going to be purchased? Those sorts of things could impact the performance of the business going forward. And again, no right answer to these questions. It's going to be very case by case, but what I'd suggest is getting on the same page early so there aren't disputes later. And lastly, once these formulas are worked out, always good to set, what are called SMART goals. You may have heard this acronym before. It stands for specific, measurable, achievable, relevant, and time-based, meaning there are clear time parameters in place. SMART goals tend to, keep everyone aligned, increase motivation, and hopefully reduce ambiguity so that potential misunderstandings and conflict can be averted.
Great. And now we will take another break. That concludes our third and final segment of our presentation. Pitt, Greg, and Jen are available to answer questions on this section or anything we might have missed along the way.
Yeah, so one of the questions we've got is someone is asking, I've heard a lot about earnouts recently, and they seem to create a lot of contention. Why are they used?
Yeah, they do. They do sometimes create contention. I think where we see them most is where there's a kind of a healthy discrepancy between historical performance of the business and projected performance of the business, and maybe the owner has put the pieces in place, and there's a nice pipeline of business that would support a material increase in the earnings of the business, but obviously that hasn't happened yet, and so an earnout sort of a way to bridge those two. A buyer might say, for instance, I'll pay you for what you've done. And, and in addition, if you achieve what you say you're going to do, I'll pay you for that as well. But I'm not going to give you that extra piece up front until you've achieved it. That way, if the seller is right, if they're able to achieve that goal, if they in fact do, then they're rewarded for it, and the buyer is protected if they don't.
Thanks, Ben. One more question, I think, which would probably apply to a lot of sellers. Can you speak to the timeline of how long a buyer would expect the previous business owner to stay involved after the sale? And should I look to sell my business a few years before I ideally want to retire?
Well, to the second part of that question about staying on after a sale, I would say ideally yes. I mean, your business is, if you're an involved owner, if you have key relationships, if you're driving the culture and the strategy of that business, and usually it's one or many of those, your business is going to be more attractive and more valuable with some degree of ongoing involvement. So, absolutely think about this ahead of when you want to retire. It's rarely do we see situations where the business owner just kind of hands over the keys and he or she is done upon the completion of a transaction. And then how long? I mean, it depends. I would think a year at least. Sometimes there's some milestones in place in terms of maybe some things you as a seller may want to accomplish under new ownership. So it could be, around getting to a certain sales level or expanding the business in some other way. But from the buyer's perspective, generally speaking, the longer the better. Like not that you need to commit long term, but that there's an interest in staying on, and there's some unfinished business. There's some stuff you'd still like to accomplish. Maybe not as an owner, but as in a continued senior operating role with the business. It also looks like we have a question about just kind of the length of a transaction and how long these typically take. We generally, when we enter into this and we're working with a client and sort of mapping out the process, we will generally come up with about a 7-month timeline, and that's pretty, I won't say accelerated, but it's tight. And the reality is there are probably some weeks that get added along the way. So I think 7 to 9 months is sort of a realistic timeline. 7 if there are no hiccups, but 9 maybe more likely and more common. And part of that is, and I think the question alludes to this too, in terms of sort of from LOI to close. that's usually 90 days. And that typically starts with diligence, and it's sort of sequential with the legal work that needs to get done. Once most of the diligence work is done, or the buyer's sort of 3/4 of the way through, and there don't appear to be any kind of major discrepancies or misunderstandings or misrepresentations, that sort of thing, that's when they will get the attorneys involved and start drafting legal documents, which would include, the purchase and sale agreement, but also, potentially a lease, employment contract that might involve, a seller who's reinvesting in the business going forward, things like that. So that legal stuff is maybe the last 6 weeks of a 3-month stretch. I think we've covered most of it. I know there'll be some opportunities for us to follow up. Amy, do you want to wrap things up for us?
I will. Thank you so much for joining today's webinar, everyone. We do hope you found it valuable and informative. We're always trying to learn and improve at what we do, so if you wouldn't mind, we have a brief survey that we will display momentarily. We would certainly appreciate your feedback. If you have additional questions about today's content or would like to be contacted by one of today's presenters, please use the survey to let us know, and we'll be sure to follow up accordingly. Thank you again for joining us, and have a great day.